Welcome to part 4 and the final part of this series talking about types of loans. I'm going to move pretty quickly because it's a lot of info. Please watch my other videos for the other types of home loans I discussed. These loans are what you can get if you already own your home and you want to get some cash out of it. So one is a home equity loan. So this is a loan against your home using your home's equity. If you're not sure what equity means, I'll have another video on that later. It can be used for anything you want. You'll receive a lump sum of money. And although you can use it for anything you want, it's encouraged to use it towards home improvements that will add value to your home when you go to resell it. But if you need that money for other things, you can use it for other things. It has a fixed interest rate that you'll pay over time, and it's essentially a second mortgage, or if your home is paid off, it will be your primary mortgage. It does add a lien to your home, meaning that it must be paid off before you can sell it. And if you don't pay it, your home could be foreclosed on by the bank because it's another lien against your home. It typically has lower closing costs than a refinance and higher interest rates than a refinance, which I'll go over last. The other kind of loan is a home equity line of credit, or a HELOC. This could also be used for anything you want, but encouraged to use towards value-adding home improvements. But instead of getting a lump sum, it's going to be used like a credit card. So whatever your available balance is, that's your loan amount, but then you spend that money as needed like a credit card. It has a variable interest rate similar to a credit card, so your monthly payments will vary. And it's also a second mortgage or primary if your home is paid off. It adds a lien to your home. It does have lower closing costs than a refi, but higher interest rates than a refi. So lastly, let's talk about refinancing. So people may refinance their home, and what it does is it replaces the original mortgage. So it's not a second mortgage. It's going to replace the first one. People use this to get better rates or terms. So if interest rates get really low, like they did over the past 2 years, we had a lot of people refinancing. You can also convert an FHA loan to a conventional loan, which can drop the PMI or the MIP. See my previous videos about what those mean. You can also get the cash out. So the home's equity, you can get cash for that and have a new mortgage with a lower rate or payment. It does have higher closing costs than a HELOC or a home equity loan, but lower interest rates. So you'll want to make sure it makes sense that you're going to be in the home long enough that paying those closing costs makes sense. But if you have any questions, let me know. Keep watching at Nicole and HTX to learn more about the real estate process.